Crypto is alive, moisturized, and thriving in China. That much is clear from a new report on 5 major crypto markets in East Asia, which conspicuously features China alongside South Korea, Taiwan, Thailand, and Vietnam. Today, we're bringing you the highlights from this report, including the scoop on China and all the other intel you need to be prepared for the Asia hours. Because we all know they can get a little wild. And remember, there are no borders in crypto, so wherever you are, this is a video that you don't want to miss. The report that we're looking at today is called Asia's Cryptocurrency Market Report. It was published earlier this month by Kairos Ventures, a VC and crypto project incubator in Vietnam. It's just 9 pages, so it's worth taking a moment to read it. The link is in the description. Now, the report compiles data from a December 2023 online survey of 5,286 respondents in China, Vietnam, South Korea, Thailand, and Taiwan. The majority of the respondents were from Vietnam, but Kairos claims to have ameliorated this with unspecified data analysis and cleansing methods. We'll have to take their word for it on that one. Another thing worth mentioning is that there's no information about who the respondents were or how they were recruited. When it comes to interpreting survey results, the devil tends to be in the details, so it's a bit of a shame they left that to our imagination. But having read the survey from top to bottom, we feel it's safe to say that the sample was taken from crypto users of one kind or another, rather than the general public. Anyway, before we start reeling off statistics, there's something we have to address. China. What happened to the ban? You see, apparently a lot of people in China didn't get the memo because they're still trading crypto like nobody's business. According to the Wall Street Journal, China was Binance's biggest market last year, with 900,000 active users. These users were responsible for a whopping $90 billion of traded volume in May alone. And according to the Kairos report, 89% of Chinese crypto users are trading on centralized exchanges. It's not exactly the kind of stealthy approach you would expect to find in a country hell-bent on stamping out crypto. So what gives? Did they ban crypto or not? Well, as it happens, it depends who you ask. Coinbase's website, for example, has an impressive timeline of China's crypto crackdowns, beginning with a pledge to prohibit virtual currencies from June 2009. You gotta hand it to them, they were early. And it was all downhill from there until 2021, when the government introduced its most extensive restrictions yet. These included declaring crypto-related business activities illegal, banning domestic centralized exchanges, and forbidding overseas exchanges from providing services to people in China. There was a major crackdown on domestic mining operations too. It was this round of restrictions that was packaged in English as China's crypto ban. And you have to admit, it's not the most bullish set of policies, is it? But almost 3 years on, crypto appears to be booming in China. Recently, Reuters reported on how China's retail investors are turning to Bitcoin as the country's TradFi starts to creak at the seams. So if China's crypto crackdown has retail quaking in their boots, they're certainly doing a good job of hiding it. The journalist Emily Parker wrote a fresh take on this whole situation that made a lot of sense to us. Here's the gist. The restrictions are enough to deter the vast majority of people and businesses from adopting crypto, and the government appears to be prepared to settle for this, at least for the moment. That's because to go the extra mile and enforce a zero-tolerance ban on anything and everything crypto, that would be really difficult. Perhaps more trouble than it's worth. Call it diminishing returns, if you will. That means the restrictions that are described in terms of a blanket crypto ban in the Western media are more akin to a dragnet. In other words, if you really want to buy and sell crypto, there is no shortage of holes you can slip through, some bigger than others. For one thing, the government never said it was illegal to own cryptocurrency, nor for individuals to trade crypto peer-to-peer. That's likely why Chinese industry insiders, cited by CoinDesk, answered overwhelmingly no when asked if they thought crypto was banned in China. And if you don't find the anonymous anecdotes from China's crypto industry convincing, Don't worry, because there's more. What really caught our eye in the CoinDesk article was a pair of legal opinions that supported this view. Parker cites a Chinese law firm who stated plainly that China, and I quote, has no laws or administrative regulations prohibiting Bitcoin trading activities. She also references an article published by authorities from a court in Fujian province who say that administrative laws and policies do not completely prohibit virtual currency transactions. Now, I don't know about you, but if I was a legal professional in China, I wouldn't stick my neck out to claim that something was legal when it's not. Who knows, maybe those are some brave degens masquerading as legal experts, but we'll take their word for it. So, crypto in China. Thoroughly cracked down upon, yes, but entirely banned, not quite. And if you don't believe us, just ask Binance. Anyway, that's why China still features prominently in market research reports, like the one we have for you today.
We interrupt this programme for an emergency crypto weather forecast. Get ready for a whirlwind of savings. We're seeing a high-pressure sign-up bonus system forming in the northeast, with some exchanges offering up to $50,000. Lush. In the south, we'll be seeing some heavy discounts on hardware wallets, so watch out for those if you're going to be out and about. And then, over in central areas, there's a high chance of trading fee discounts, which should be setting in later on, up to 60% off there. Amazing! For a more comprehensive forecast, visit the Coin Bureau deals page using the link in the description. These deals are red hot, so make sure to take all necessary precautions. That's all for the forecast. Now back to our scheduled programme.
So without further ado, let's get into it. The report begins with a few highlights, some of which are more riveting than others. We can see that the general market sentiment was better in 2023 than it was in 2022, and Arbitrum and optimism are growing fast. All right, tell me something I don't know. Then the good stuff starts. Right off the bat, we were surprised to read that among the 5 countries, crypto investors in Thailand and China had the highest risk tolerance and profit expectations, and the lowest levels of patience. This caught us off guard because of our recent brush with the risk-hungry and time-strapped traders of South Korea. Now, if you have seen our video about Korea's crypto market, then you might be wondering how anyone beat them at their own game. If you haven't seen it yet, it's a good one, so check it out, the link is in the description. While you're down there, hit the like button and give the video a boost. Let's take a moment to address the risk. Kairos dedicated a section of its report to risk tolerance, which they measured by how much of a respondent's investment portfolio is taken up by crypto. As crypto is considered a risky asset class, this makes sense. Just over 70% of all respondents across the 5 countries said that crypto accounted for more than half of their portfolio. For a survey presumably of crypto users, it's not a shocking statistic. But when you break it down by country, things start to get interesting. China came out on top with almost 90% of respondents saying that cryptocurrency accounts for more than half of their portfolio. This is far ahead of the second place, which was occupied by Thailand at 72%. And in last place was none other than South Korea, with barely over 57%. Kairos doesn't attempt to explain the results of its survey. This means our imaginations are left to run a little bit. We think it's safe to say that China's lagging economy and stock market have made crypto more attractive to investors in the country. We can also speculate that China's restrictions on crypto have filtered out a lot of casual participants, leaving a subset of the population who are relatively determined and perhaps also a little more dedicated to investing in crypto. And in some respects, Korea is the exact opposite. Crypto is mainstream and made highly convenient by the upbit industrial complex. Most trading pairs on Korean exchanges are fiat to crypto, making on and off-ramping a non-issue. To us, all of this suggests a high level of pedestrian involvement. Think Doge gamblers and kimchi coin gamblers, who might be less interested in pouring more than half of their savings into crypto. The next metric that stood out to us was stablecoin holding. Kairos uses this as another measure of risk appetite because the more of your portfolio is in stables, the less exposed you are to market volatility. And just so we're all on the same page, we're mostly talking about US dollar stablecoins here. This isn't specified in Kairos' latest report, but last year they published a survey indicating that USDT is overwhelmingly the most popular stablecoin in the region. Now, when it came to measuring stablecoin holdings, the survey took a pretty blunt approach. It looks like respondents were simply asked if they were holding a large amount of stablecoins. That's definitely going to mean different things to different people, but let's go with it. The results show a remarkable gap between Vietnam and Thailand, where respondents reported the highest and lowest levels of stablecoin holdings. In Vietnam, 56% said they were holding large amounts of stables, whereas just 22% of respondents in Thailand said the same. So why such a big gap? In Vietnam's case, the dollarization of the economy is well-documented historical phenomenon. Vietnam's national currency, the dong, is prone to bouts of high inflation, leading to widespread adoption of the US dollar as a hedge and store of wealth. Although the government has been trying to curtail dollarization in recent years, it seems the dollar still casts a long shadow over the economy. Vietnam also has a large population of people who are unbanked or otherwise lack access to financial services. All of this sounds to us like a very fertile ground for adoption of US dollar-pegged stablecoins. As for Thailand, we suspect a few factors can account for the lower reported stablecoin holdings. To set the tone, let's recall that Thailand's central bank declared Terra's Thai baht stablecoin illegal back in 2021. The bank dusted off an arcane statute for the occasion, warning that the creation, issuance, usage, or circulation of any material or token for money is a violation of the Section 9 of the Currency Act 1958. Yikes. The following year, the government made it illegal to pay for goods and services in crypto and banned domestic crypto exchanges from offering staking and lending services, which are really popular use cases for stablecoins. And apart from that, Thailand already has a very high adoption rate of other round-the-clock, real-time digital payment systems. Inflation is low, and the trust in the central bank is apparently high, suggesting people are not desperate to store their wealth in something other than the Thai baht, like USDT, for example. Moving on, we found another surprise at the end of the report section on risk. Kairos measured respondents' profit expectations. Vietnam, Taiwan, and China were all fairly similar, expecting around 6 to 7x returns. But once again, Thailand and South Korea popped up at the extremes. Respondents in South Korea appear to be incredibly pessimistic compared to the rest of the region, expecting a 2.6x on their initial investment. Meanwhile, Thailand is apparently East Asia's very own Lambo moon boy, with respondents reporting expected gains of 10.4x on average. Now, this one really had our heads scratching. Between Thai respondents' crypto-heavy investment portfolios, their comparatively low stablecoin holdings, and ambitious profit expectations, it seems they're very risk-on and bullish. But why is that? We know there's generally a favorable and clear regulatory environment in Thailand. We know crypto adoption is growing fast. We even know that Thailand had a higher per capita coin market cap visit rate than the United States last year. But none of this seems to explain why profit expectations in particular is so much higher than these other countries surveyed. If you think you know why Thai investors have such high targets, please let us know in the comments. Now, South Koreans' exceptionally conservative targets also caught us off guard, but we're not sure what the reason is. Between Korea's XRP addiction and its sideways-only stock market, investors may have become resigned to an eternity of horizontal price action. But really, we're grasping at straws here, so we'll call this one food for thought and grounds for further research. Another section of the report that we found noteworthy uses the survey data to profile investors in each country. This includes gauging investors' familiarity bias, which produced some really interesting results. The survey set out to measure preferences for familiar products by asking respondents if they would buy tokens of a product they were frequently exposed to. We wonder if products can be understood to mean brands here, but the report specifically said tokens of a product, so we'll refrain from reinterpreting the wording. Anyway, respondents had to choose one of 4 answers: do not invest, not sure, need to research more, consider to buy later, and participate in token sales. These responses are all mapped out on a chart and they are all over the place. The first thing that we noticed was the negligible level of do not invest responses. Thailand and China appeared to have close to 0, while somewhere between 0 and 5% of responses from Taiwan and Vietnam were do not invest. When it comes to participating in token sales, respondents in Vietnam and Thailand appear exceptionally eager to ape. In both countries, a little over 40% of respondents said they would participate in token sales. As the report points out, this is a much higher level than other countries. Interestingly, considered to buy later was by far the most common response in China and Taiwan, with both in the mid-60% range. Incidentally, this made us wonder how we could interpret the difference between the responses considered to buy later and not sure, need to research more. The only thing we know about these hypothetical tokens is that they're associated with a familiar product. Naturally, this indicates that nobody has done their own research, and that's impossible. And in that case, choosing consider to buy later over not sure, need to research more seems to suggest a respondent who wants to defer their investment but doesn't feel the need to research first. Perhaps we're overthinking this, but it's worth pondering details like this when trying to draw conclusions from survey data. Now, like we said, the responses are kind of all over the place, but there's still one country whose respondents stick out like a sore thumb. Surprise, surprise, it's South Korea. Close to 0 respondents said they would participate in token sales, and around 14% said they wouldn't invest at all. These responses were respectively the lowest and the highest among all countries surveyed. By far, the most common answer in South Korea was not sure, need to research more, which accounted for 70% of all responses. This was a far higher level than any other country and suggests that Koreans are generally unwilling to blindly ape into tokens just because of their association with a familiar product. Moving on, the last section that we'll cover measured respondents' usage of Web3 products and I quote, token investments, broken into 5 categories. These are CeFi, DeFi, SocialFi, GameFi, and NFTs. To be honest, this section left us with more questions than answers. For one thing, it compares product usage and token investments in terms that make the two sound mutually exclusive. For example, and I quote, Vietnam and China prefer token investments, particularly within DeFi. The language makes it clear that this means as opposed to using DeFi products. And sure, the numbers show a big contrast. More than 75% of respondents in Vietnam reported investing in DeFi tokens, while the percentage who reported using DeFi products is below half of that. But these are not at all mutually exclusive behaviors, so we're not sure that the use of prefer makes total sense here. And of course, some Web3 products and applications require users to hold a native token for transactions, governance, or other kinds of access. In such cases, using the product and investing in the token are mutually inclusive, so the whole framing of product usage versus token investment seems a little bit odd. The other issue is that some categories might mean different things to different people. In particular, SocialFi. The survey data showed an exceptionally high level of SocialFi product usage reported in South Korea. But what exactly does SocialFi mean? When we think of SocialFi, the first thing that comes to our mind is Friend.tech, a quintessentially Web3 social media platform that enjoyed 15 minutes of fame last summer. But where do we draw the line between Web2 social media and Web3 SocialFi? Look at KakaoTalk, South Korea's ubiquitous messaging app. If you search for it, you can find an in-app crypto wallet, but the vast majority of users have never touched it, and instead use the app in a very Web2 fashion. And what about Telegram? It has countless crypto applications built on top of it. Does that make it SocialFi? Perhaps not, but we think terms could be better defined here. We don't know how respondents interpreted SocialFi, but unless they were given a very clear definition, we suspect that different respondents would have different ideas. And if we turn to the token investment bar chart, it basically tells us which narratives respondents were investing in. If that's the purpose of this chart, then why not include such major narratives as AI, DeepIn, and Layer 1s? Although this wasn't the most illuminating section, at least it made us think about how we should document and define the narrative and use cases of Web3. Overall, despite some limitations, this report was an interesting contribution from Kairos Ventures. We'll look forward to their next report and bear in mind what we learned about investors and the markets that we're up against in the Asia Hours. And let's end on a heartwarming note. The Chinese degens have not gone anywhere, so they might still pump our bags. Booyah! Well, that's all for this video. If you learned something new about the crypto markets in East Asia, don't forget to click that like button. While you're down there, let us know what you think about the status of crypto in China in the comments. Make sure to subscribe and ding the bell notification so you can be the first to line up for Coin Bureau uploads. And remember to save yourself money by visiting the Coin Bureau deals page too. The link is in the description. As always, thank you for watching, and I'll see you next time. This is Jessica, out.